As a little bit of a preface here, I mean, I've been looking forward to having this panel for a long time. The concept of pre-validation, the concept of what we're going to get into within Mojaloop, the agreement of terms, is honestly something I don't think I understood for the first 3 years I was working on Mojaloop. In fact, I don't think I even knew what it was for the first 3 years I was working on Mojaloop. And I remember it was a conversation that I had with Michael and Warren, and it was a moment where they understood that I didn't know what agreement of terms was. And it was this shock that they had of, this is the most core part of Mojaloop. How is it possible that you don't understand it? And that started us on a discussion of, okay, maybe we should talk about agreement of terms more regularly and make sure that everybody understands what it is and what the value of it is, because it's not something that we talk about often enough. A lot of us just kind of took for granted that everyone had seen that it was the main value proposition, technical value proposition of Mojaloop. And that wasn't the case. So I've been looking forward to having this panel, like I said, for a long time, because this is one of the key value propositions of Mojaloop. It is one of the key areas that distinguishes it. And not just, but it makes it different, but also that there are other people looking at very similar types of pre-validation. So it's not only Mojaloop. And so I think that concept of pre-validation is something that is not talked about regularly enough. And so that's what we hope to do today. So we're going to mostly go down the line. But so Miller, I'd like to start with you. Actually, first, brief introductions, if we can. I think Simeon said your names, but who you are, where you're from, please.
Yes, hi, I'm Miller Abel. I'm the principal technologist for the Gates Foundation, and I don't know, I've been called various things, the convener of the Mojaloop project back in 2016. Yeah, so enough for this, I guess.
Actually, Godfather is the term we mostly use. Hi, I'm Michael Richards. I'm the principal architect at the Mojaloop Foundation. And for 7 years now, something like that, 7 or 8 years. Anyway, that's me.
Hi, everyone. Mike Truter from Swift. I'm not a principal. I'm one of the naughty kids. So I have been working on interoperability of instant payment systems on Swift, but before that on many other things. And one of the things I've learned is that pre-validation is critical to make payments work efficiently end to end.
Yeah, good morning. Alan Kajangwe, founder and CEO of Wiredin. Currently working on IIPS deployments with RSwitch. Obviously, the Mojaloop deployments that has been done in Rwanda, we helped RSwitch deal with that.
Thanks, everyone. So Miller, again, starting with you. Can you explain why pre-validation, not specifically agreement of terms, but why pre-validation itself is so important to financial inclusion and scale, but focusing on financial inclusion?
Yeah, I guess to understand it, we would go back to the level 1 project and the level 1 project principles that are the evidence base that underlies the work that we do at the Gates Foundation in infrastructure-based financial inclusion. One of those is transparency of terms. And what we mean by that is that when you go to authorize a payment, you know who you're going to pay with some legal authority. You know what the terms are. You know what the fees are. That is the total cost of making that payment. And so you have an expectation of the outcome before you release the payment. In the traditional world for payments in the developed world, it's usually done on a best efforts basis. You do enough work up front to decide who to pay, you study it, you get it carefully done, and you shoot it off into the ether, and it either succeeds or it doesn't succeed. But during the process of doing that, your money's on hold, and it may not necessarily succeed, in which case you didn't have the use of money, but you also didn't accomplish your economic goal of making that payment. And so we want to shorten that cycle to where the payments themselves, as proposed, generally would succeed. And so when looking at the design of the Mojaloop system, we couldn't find a readily accessible way of doing this through the existing mechanisms. we looked at some of the practices in mobile money and said those could be expanded and probably solidified. And one of the things that the Level 1 project did early on was a set of discussions with M-Pesa in Kenya to say, put the legal name in front of the user before they authorize the payment. That crashed fraud, and it crashed a large portion of failed payments, or those that required dispute management later. And that became one of the evidence points that we used in designing the Mojaloop Agreement of Terms system, which, as you point out, is a very specific kind of pre-validation, but one that we think is fundamental to the Mojaloop.
I think that's the key. Like, I'm glad you brought up the transparency and that there are these level 1 principles, and in order to meet several of the level 1 principles, specifically you brought up transparency, the agreement of terms or pre-validation is required. Pre-validation is required. Some of the other ones of low cost, I think, is what we can get into with specifically agreement of terms. Before doing that, then I'd like to ask Mike, as the non-Mojaloop person on the panel here, when we think of pre-validation, we think of our specific version, which is agreement of terms, but that's not the only thing out there, and Swift has some as well. Can you talk to us about pre-validation?
So I think Miller touched on it quite nicely in the, shall we say, the traditional space, how things used to work. You know, there's this concept of serial payments where there's multiple parties in a chain, and whoever's originating the payment fills in a bunch of fields and then throws them through the system, and it gets to the other side, hopefully, and so on. I think one of the key challenges that we've seen there is that the person initiating it definitely over time, it's become more complex because of financial crime, the need for AML screening, and so on. So we've seen this increase in the number of mandatory elements that are required to be included that have to be accurate. So it's become harder and harder to actually land a payment to the other side on a cross-border basis. Domestically, it's relatively simple because the scheme rules are well understood. On a cross-border basis, the scheme rules in the receiving economy or the jurisdiction tend not to be there. So the real challenge is, how do we expose all of these things that are mandatory in a domestic economy, in a domestic jurisdiction, and make them available upfront? And if we can do that, we can address a lot of the challenges. So just in terms of a few figures, I think something like 65% of the payments that flow across Swift that have an issue have issues related to some form of addressing, like, is the account number correct? Is the person correct? And so on. But there's a number of other issues that really come into this. And so from a Swift perspective, for many years, to increase the, shall we say, straight through processing or reduce the failure rates, we've been focusing a lot on building pre-validation services that allow us to address those key challenges, the ones that have the biggest impact on the transaction flowing through the system. And so the idea is, maybe I can give a few examples of pre-validation, the way we think about it. Again, it's very much focused on what are the key things that stop STP or stop a transaction settling at the end, or clearing at the end. And the key one is getting the address, the account number correct. And so that account number pre-validation is there. Swift has a number of APIs that are available to do exactly that. So you kind of send or check the API. You say, does this account number exist? And you check a few things. 1, does it exist? 2, can it receive funds? And 3, who does it belong to? What's the name there? So this confirmation of payee type thing. The challenge that certainly happens, and this is one thing that I think is really tricky, is getting access to that data shared consistently at scale. So typically when we think about the pre-validation challenge, what we want to do is, of course, Swift traditionally had a bank on the other side. If those banks make the data available to do those checks, that's great. If they don't, then you just have to chuck it and hope it gets to the other side. And so what we've done is said, okay, well, that's not enough. First, we get banks to provide this data. What else could we do? What we could do, we actually have, upwards of 50 million transactions a day flowing through our system. Actually, we understand from that data which accounts are open, which ones are valid, if there's a transaction that's flowed through in a certain period of time. So we can start to give back an estimation or a kind of a level of understanding of, will this transaction succeed? Is this account number correct? Is it linked to the right person? And so we can give people an indication that, yes, we think this is. It's a level of not 100%, but probably will succeed. That's great as well, but it's only an estimation. So I think what we're seeing now in the market, a lot that's happening, is that we're looking at central data sources. So we've got proxy databases that exist, or alias resolution systems, or confirmation of pay solutions that are existing, and saying, wouldn't it be nice to have that central source of data that could plug in one shot and cover the entire market and give accuracy of that data? The challenge is, that's great, but it doesn't tell us what mandatory elements are still required by that jurisdiction. And so I think what we're facing is this challenge of constantly trying to, with reducing kind of gains, to a certain extent, tick off all these things, bring the data services online that allow us to fully pre-validate something in the initiation channel, which is typically in front of the banks or the service provided PSPs, and bring a consistent service. And I think this is all about getting a customer experience that's consistent with accurate data that allows a payment to process end to end. I've talked a lot. There's a lot in there, but I think really important. And maybe one point that I can kind of bring up at the end. One of the big challenges that we certainly see for pre-validation is exposing the data from that country outside of its walls. And because it's personal data, that's often a challenge. So we do see this oftentimes as a problem of data sharing more than anything else, because we need to expose the data, put it in a consistent way, bring some standards around it as well, which is very important as well, so that regardless of which country you're reaching out to, regardless of how you're initiating a payment, you get a consistent experience, you get consistent data integrity, validation as well. If we can get that right, we can make payments better, faster, and cheaper, even the serial payments. And then, of course, you've got the kind of ultimate goal is getting an orchestrated payment end to end, which is exactly what you're doing through the discovery, agreement of terms, and kind of execution phase that Moduloop has, which is the next level, which something for us to all aspire to.
Okay. So you did say quite a bit there, and I think there was at about 5 different stages. I was like, okay, I want to debate that point a little bit more. I mean, one of the things was, which I mean, it's not a debate, but I mean, I think it would be an interesting conversation for our community to have of what is the relative value of, you focused on the value of pre-validation in the cross-border use case. And I don't think anyone would argue that it's more important, but I think how much more, what is that relative of, and so the importance of it is also in the domestic use case. And the other one is when we think about a SWIFT transaction of, I mean, if we're lucky, $100, but most likely 500 or much more. And so what is the impact of not having pre-validation on a certain flow of $500 transactions or even $100 transactions cross-border versus what's the impact of not having it on a $1 transaction to the person right in front of me? I'm not saying it more or less, I'm saying I think that the impact of not having pre-validation is a very different discussion on those two issues, because one of those, it's worth it to track it down. One of those, it's not. And so, so I'd like to then move over to Michael to talk about specifically how Moduloop has done it, whether in the context of what I just said or not, but to talk about the agreement of terms and the benefits of agreement of terms specifically, in addition to everything Mike just pointed out.
Thanks very much. I was interested, well, of course, in what Mike was saying. But one of the things that I was most interested in is that he was describing an arc in which SWIFT provided ever more detailed and sophisticated central services to their customers to enable them to understand whether payments were likely to succeed or not. Now, it's easy to go away with the idea that Moduloop is a centralized system because that's what we talk about. We talk about the switch all the time and what the switch does and all of those kinds of things. But one of the original design decisions, which I think was one of the best design decisions of all, was essentially that Moduloop is there to orchestrate agreements between institutions of very different kinds without those institutions needing to know anything about the institution they're in correspondence with. So, as you know, Mojaloop uses identifiers, something that the customer knows about where they want to send the money. It's not an account number. We don't want to know which account is going to be credited. What we want to do is we want to get a commitment from the crediting institution that they know which account is going to be credited and that they are going to credit it. Now, one of the other things that we want to do is we want to make sure that if 4 people are going to be using a system which involves money being taken out of their accounts, they always know how much money that's going to be, and they can always rely on that. And they know that in advance of deciding whether or not they're going to make the payment. So again, another thing that the agreement of terms does is it enables the crediting institution to report back and say, I am going to take this amount of money to make this payment. And that is something which they can, the debtor institution, the sending customers institution, can give back to their customer and say, I guarantee that if you make this payment, this is the exact amount that's going to be debited from your account, and this is the exact amount that your customer is going to get. Now, it's possible, of course, to make those rules at a general level, at a scheme level, or as a switch level, or over a large institution level like SWIFT. But it's much simpler and easier and adaptable to all kinds of different conditions, we think, to enable the institutions themselves to make those decisions and communicate them to each other. Now, what we're also trying to do is we're trying to support very small payments, and that means we need to make them as cheap as we possibly can. One of the major costs associated with payment systems of all kinds is, Mike's talked about it already, the cost of failed payments. Now, if we look at something like cross-border payments, then it's estimated roughly 15% of cross-border payments fail, and each of those payments costs an average of $12 to fix. Now, that doesn't sound like much, does it? But if you average that over the cost of all the payments that are being made, it comes out at about $150 per payment, which sounds like even less, except when you think of the G20 targets for the cost of cross-border payments. What that means is that at 3%, a payment of under $150 would lose money, even if that was the only cost associated with making that payment. So what we're essentially saying is all of the mistakes that are made that stop payments succeeding mean that low-value payments become economically unviable for the people who are making them. They cost more to make than you get. Now, that's obviously an intolerable situation for a mission like ours, a mission that says we need to be able to support the smallest payments that we possibly can. And that means we need to be guaranteeing that those payments will succeed. We can't stop people making mistakes. We can't stop people typing in the wrong number, trying to make payments that they're not allowed to make and things like that. But what we can do is make sure that those mistakes get picked up and remedied before anyone is asked to commit funds. So what our agreement of terms does is it allows the creditor institution to say, I promise that I will make this payment and that this is how much it will cost. And they make that promise in a way with a cryptographic lock, which means that everybody who's involved in the payment can act on that payment with confidence. That's a binding promise in the context of the system. And that, I think, is the real difference about the way in which we do things. And it's not just, sorry to go on, it's not just that, but it also means, for instance, that one of the problems that is going to happen for cross-border payments is that FATF, Financial Action Task Force, is going to ask people to ensure that payee information is available before the payment is made. Now, in the normal run of things where you just say, okay, I think I'm going to make a payment, I'll throw it over the fence and see what happens, you may have an idea of information about who's being paid, but probably you won't. You might only have an account number, pardon me, a phone number, something like that. The agreement of terms means that you get reliable information back from the creditor institution, the institution you're dealing with, to say, I warrant that this is my customer and that they are legally allowed to receive the payment that you propose. Again, it gives much more confidence to the sending institution that if they make a payment of this kind, it's a payment that will go through and for which the regulator won't come and say, why did you make that payment? So there are all kinds of reasons why what is apparently quite a simple way of doing things is something which has all sorts of benefits to the Mojaloop system overall.
Okay.
I was just going to say, I wonder if we could get to that, the risk becomes smaller. You could charge less for it because you know it's going to succeed, and where you've got less clarity of information, you could charge more, which kind of is what's happening, right?
I mean, I would love to ask you, Mike, can you talk to your member banks about that? About reducing their prices?
I think we come back again to this point that people are pricing their risk, and they're charging to cover things that they know payments are going to fail. It's not just our members, it's everyone involved in the cross-border space has to cover their costs, right? It needs to be a sustainable business.
Sorry, Mike, we need to get to, we've got 8 minutes left and there's a key part of this I want to keep going on, but I do want to highlight, you made the point I was trying to make, Michael, is that when I do use SWIFT and I send money from my US bank account to my Indian bank account, like the possibility that the person in the US misspells the address of my bank and that's what causes it to fail is a very different problem than when I'm scanning a QR in UPI, making a 50-cent transaction, and there's a problem with the account holder on the other end of it. So those are two very different challenges with two very different outcomes. So thank you both for highlighting both of those. But Alain, I really want to get to you because these are all great things. We're debating relative how valuable this is in all of its different mechanisms. But great to talk about idealistically what it should look, the world should look like. But then how do we actually achieve that is a bit of a challenge. So you've been on the receiving end of that, of how do you actually get DFSPs to adopt this type of protocol and the challenges from that. So you can talk about your experiences with that challenge.
Yeah, thank you, Steve. So first of all, so we all understand if we want to implement a payment ecosystem that respects the one level principles, you have to have pricing transparency and whatnot. But there are challenges, like you said, that will come when you're actually thinking about adoption, right? So for instance, you'll be dealing with participants that are at different maturity levels, right? That already have systems that they've been running for quite some time. And here we're talking about obviously a transaction in three phases, right? So there's this discovery phase, the quoting phase or agreement of terms, and then finally the transfer phase, right? So in our context, for instance, that middle phase does not exist, right? Yet you're dealing with participants that have done this work for so many years, right? They already have agreements in place, especially when it comes to pricing and fees and charges that are already preset and very highly regulated, which means they hardly ever change without the say-so of the central banks, right? So already you have already covered that pricing transparency, because before I do a payment, my bank already told me how much it's going to cost, right? And I can actually even go to the website and it's clearly marked. If I'm sending 1,000 francs to someone, I already know how much I'm going to be charged, right? And on the other end, the recipient bank, there's no charge on the recipient, right? So it's not like you're going to be asking the recipient how much money they're going to be receiving. They're not, basically, if I'm sending 1,000 francs, they're receiving 1,000 francs and I'll be the one being charged. That is across the board how payments are, basically transfers are happening, peer-to-peer transfers at least, are happening in Rwanda, for instance. So having said that, there are some use cases where not doing the agreement of terms phase will definitely not work. And we've talked about one of them being the cross-border payments, right? And cross-border means there is an FX component in there. And the FX basically has to come from the beneficiary bank, right? They're basically the ones to tell us if you're sending 1,000 francs, right, from a Ghanaian bank or mobile operator, in Rwanda, this is how much we're going to give the beneficiary, right? So that phase should be, without it, this would not work, obviously, right? But there are also, even in the local context, if we think about, if we are building these systems and we want to make them future-proof, there are some use cases or some services, value-added services that will most likely not also be possible or very hard to implement without this agreement of terms phase, right? For instance, if a merchant has some vouchers and I wanted to redeem some of those vouchers, right? First, I have to send that voucher to the merchant platform or institutions for them to basically say, yes, right? This voucher is valid, and this is how much of a discount you're going to get out of it before I make the payment, right? So if we are looking at making our ecosystem future-proof for this, then we definitely have to think about this agreement of term phase, right? And these are things that can be done progressively, right? Because, for instance, if we wanted to implement, because like I said, we've already implemented and deployed the modular loop in Rwanda, but we had to mute, right? And I say again, to mute it, the agreement of term phase. Why? Because on the other side, they would not know what to do with that request, right? And then to ask them to change the whole internal logic to support this would obviously not be something that would be, one, an easy conversation to have with them, right? Because it entails a lot of changes internally. It's not just the API that you're telling them to implement. There is also some internal logic that they need to work on, and that would be a very hard conversation to have with them, right? But gradually, and I like what Mike said, that challenge of having not knowing to whom you're sending money to. Before, maybe not even 5 years ago, in Rwanda, a transfer was one step, right? So I just say, I want to send money to Steve, here's Steve's account, send, right? If I mistyped your bank account or your wallet number, that money will go somewhere else. I'll never know. Maybe I'll know a few days later. And then there was a push from the central bank, actually, to now have a discoverable phase, a lookup phase, which has already been implemented across all the DFSPs, right? What I'm trying to say is it wasn't the case before, but gradually it is now a two-step transaction, right? Who's to say that tomorrow, especially since there are some very clear use cases that will demand that we have an agreement of phase. So definitely great to have, right? But there are some challenges when it comes to adoption, obviously, that we need to think about.
I wish we had more time, but we're running out. I want to close with a couple of things. Is that we've talked about a few different parts of the pre-validation. One is the transparency of the price. The other is the validation of who is this money going to, which you were just talking about, Atlanta. I do want to highlight that's incredibly important. You don't need the agreement of terms phase. Like you said, Rwanda is doing that. I mean, UPI, if I scan a QR, it tells me the name of the merchant. They're not using agreement of terms phase, but they're still able to do that. Zambia's NFS, I enter a phone number of a different operator, it tells me it automatically tells me who I'm sending money to. So that kind of pre-validation of who's the receiver, I think is something that's taken off as a key component.
Can I throw in one we're seeing a lot of concern about now is the implementation of payment purpose or regulatory reporting codes, which is another huge factor in the speed of the final leg. That's also one we need to watch out and think about how we solve.
There's a lot more things we need to talk about. So yes, all of those things. Then I would say that even with that though, even with that pre-validation, I do want to highlight some of the points that bring back to what Michael was talking about. When we're talking about a $1 or 50-cent transaction to the person right in front of me, I know who they are. I know there's no price. The agreement of terms still has value, significant value, because the possibility of a failure on that transaction is worth more than the transaction itself. And so living in a world where I use 50-cent transactions regularly with no agreement of terms, I can't even imagine how much my bank has to pay every time I have a failed 50-cent transaction. And so in terms of how do we convince DFSPs in the future, hopefully as instant payments grow, the real cost to the DFSPs and to the banks of having millions of failed transactions and all those API calls for them, even if it's automatic reversals, how much does a million fixes, even if it's automated, cost? Is it worth? So outstanding question, but thank you all so much. I'm sorry we're out of time. Clearly we need to have this conversation every single convening. I look forward to the next one. So thank you all for having this conversation with me.